Hello, I'm Shawn Cord with Bremer Bank. Managing risk is essential to being a business owner. To be a successful franchise owner, you need to know when to speed up and grow your business using debt, or when to slow down and grow with equity generated organically from your business operations. With over 25 years of experience working with franchise owners, my advice is this: your financial ratios should be one of your key guiding lights when it comes to business growth. Financial ratios are grouped into different categories, such as leverage ratios, liquidity ratios, and coverage ratios. Each financial ratio provides unique insight into the performance of your business. Since some ratios are more relevant in certain industries, knowing which ratios are important to you as a franchise owner will go a long way in setting up your business for success. The first set of ratios we'll talk about are leverage ratios. Leverage ratios measure the indebtedness of your company. Too little leverage hinders your company's ability to grow, while too much leverage can lead to bankruptcy. There are several types of leverage ratios, but the debt-to-equity ratio is one that franchisees should pay attention to. This ratio measures the total debt a franchise business is carrying compared to the amount of equity invested by its owner. A lower ratio indicates a greater ability to take on additional loans to support business expansion and growth. Consult your accountant about the ideal debt-to-equity ratio for your business. You may find it difficult to get a business loan or increase your credit exposure if your debt-to-equity ratio is too high. Another important leverage ratio is debt-to-EBITDA ratio. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It measures the cash generated by your business that is available to pay debt before covering things like interest, taxes, depreciation, and amortization expenses. You can calculate this ratio by taking the debt found on your balance sheet and dividing it by the EBITDA from your income statement. Franchise owners should aim for a lower debt-to-EBITDA ratio. There are multiple ways you can create a healthy balance between your total debt and the equity generated organically through your business operations. Some of those include paying down your loans on time, making principal reductions, and not taking on additional debt when you are trying to decrease leverage. Keeping your operations lean and efficient. Managing inventory levels, and finally, restructuring debt. Consider refinancing business loans with higher interest rates, especially when current market rates are low. This can help lower your overall debt-to-EBITDA ratio. Another important financial ratio for franchise owners to understand is liquidity ratio. Liquidity ratios indicate your company's ability to pay short-term obligations. The three liquidity ratios that are commonly used by your franchise banker include a current ratio, a quick ratio, and a cash ratio. These are calculated as follows. Current ratio is your current assets divided by your current liabilities. Quick ratio, your cash balance added to your accounts receivables plus your marketable securities divided by your current liabilities. And lastly, cash ratio, your cash balance added to your marketable securities divided by your current liabilities. Maintaining a healthy amount of liquidity is essential. Too little liquidity can lead to bankruptcy. Too much liquidity, however, warrants the question of whether management is properly using cash to maximize growth opportunities. Our final set of ratios are coverage ratios. These ratios measure a company's ability to meet its liability payments and financial obligations. When it comes to coverage ratios, franchise owners specifically should pay close attention to their cash flow coverage ratio, also known as debt service coverage ratio, or DSCR. DSCR is the most common financial ratio used by banking partners to determine the ability to repay debt. Another way to put it, a company needs $1.25 of net income for every $1 of debt they have. One key financial metric used to calculate DSCR is EBITDA. If you recall, EBITDA was mentioned earlier. Your banker finds EBITDA useful when comparing your business to other franchise operations in your industry. A cash flow coverage ratio measures the ability of a business to pay off current expenses or debt with its cash flow. Simply put, it shows the amount of money generated from your company's operation available in each period to meet your current financial obligations. Investors and banking partners are especially interested in this ratio, as it shows them whether your resources are optimally utilized to generate cash flow. Without sufficient cash flow, you may miss opportunities for important technology and equipment upgrades that can help your business stay efficient and competitive. Regular analysis of your business's financial ratios can help you recognize and adapt to trends that impact your operation, all while making informed decisions to improve your business's finances and tracking your progress towards your business goals. Since these ratios provide one of the key measures of your business's success from a cash flow, debt, and equity perspective, having favorable ratios will make a difference in your ability to obtain financing. To better meet your financial and business goals, work with a banking partner who understands your needs as a franchisee and has the expertise to both anticipate problems and recommend tailored solutions. Thank you for watching today, and be sure to check out our other educational videos on Bremer.com.